Hello, everyone. It's great to be with you again here today. Thank you for taking a few minutes to join Gary and me here with our second quarter webinar. We're going to wait just a couple seconds here, make sure everybody gets in, and then we'll get started here.
Lyle, as people are filing in, I was thinking, why did we not think ahead and find a way to do this outside somehow today? It's such a gorgeous day, yet we're in here, and hopefully some of our attendees are out on the back porch or the screened-in porch, and you'll get to enjoy this in the beauty of springtime right now.
Yeah, this would be a great time to be outside. I can slide my camera around maybe just a little bit up. No, it's not working. Can't even get the outside in from the inside.
Can't do it, and we
No.
couldn't do this one from the golf course either. So here we are.
Yeah, it's great. Hey, well, again, thanks for everybody for joining us here. Gary's prepared some great material for us again this quarter. So Gary, take it away. What do you got for us today?
Great. Yeah, thanks, Lyle. Really excited to be with everybody today. Thanks for taking the time to be with us here for the next hour. As always, any questions that you have as we go through the webinar, please put them in the chat or the Q&A. Either one works. We'll be monitoring that throughout the duration of the webinar. And feel free to ask any and every question that you can. Lyle and I were talking before the webinar, and Lyle said, well, I don't think anyone stumped you yet. So that's the challenge for you today. You got to try to ask a question that's going to stump me, because then you'll get to hear Lyle answer a question, because anything that stumps me, he has an answer for. So that's your challenge as an attendee today.
I'm not worried. It's not getting past Gary.
Great. Well, let's dive in. We've got 3 topics for you today. And really, we developed this webinar based on the conversations we've been having with a lot of you here over the first quarter of the year. And what we wanted to do is make sure we're bringing content to you that's relevant to you and your specific situation. And so the 3 things that really we've been hearing a lot about so far this year are, first and foremost, this is a conversation we've had with, Lyle, dozens and dozens of clients.
Yep.
Hey, my cash is finally paying me something. What should I do with that? And so we're going to go through that first, talk about positioning cash. Also, unfortunately, sometimes during these, I have to be the bearer of a little bit of bad news. So we're going to talk a little bit about cash and inflation and how those two things relate to each other. Second, we need to talk about bonds. Many of you, all of you, to some capacity, have bonds in your portfolio. And especially if you're getting close to retirement or you're just past retirement, bonds are a pretty major part of your portfolio. And last year was the worst year for bonds in recorded market history. So what do we do with that? And what's next for the bond market? We're going to dive into that. And then we're going to wrap up with a conversation around international stocks and how we should think about investing internationally. We've gone through this long period of time that we'll look at in more detail, where the United States has outperformed international stocks by a pretty wide margin and for a pretty significant length of time. And so the question that's coming up is, why should I be picking anything over the United States as far as investing goes? And we'll address that as well. So we're going to start with positioning cash. What are we talking about when we're talking about cash? I want to start with just setting the conversation appropriately to establish a few things. One, cash is not a long-term investment strategy. Cash is a short-term investment strategy. What we see here is, what kind of investments do I want for different lengths of time that I'm investing for? For my short-term goals, I want cash and cash equivalents. For my medium-term goals, maybe 5, 10, even 15 years, I can invest in some stocks, but I want to hold more bonds and cash than I do stocks for those goals. But for those long-term goals that are 15 years plus, I need to be in mostly stocks so that I can get the benefit of compounding interest over time and reach my long-term goals. There's a couple of numbers down here that simply runs through the fact that with cash, it's a safe investment, and by its nature, it usually is not going to hurt us all that much, especially not year to year, and especially not before adjusting for inflation, which again, we'll get to. And the more risk I take, the wider the possibility of returns becomes. But what we see down here is the longer my period of time, the more confidence I can have that even a more aggressive portfolio made up of mostly stocks is going to be a good long-term investment for me. The worst 20-year period in stocks, the worst one, got you 6% a year. I think most of us would say, I'm not thrilled with that, but that's historically my worst case scenario. I can live being in stocks for 15 plus year time horizons. And so that's part of what we're here for as your financial advisors, is to help you decide, how do I allocate my investments and my cash appropriately in a way that coincides with my goals that are in the future. One of the hidden risks that we have when we're talking about cash is inflation. And inflation's been a story we talked about in the first quarter. We're not talking about it as much today, but we're still talking about it, and we're certainly still seeing it in a lot of the regular areas of our lives, whether it be food or at the gas pump again. Now we're climbing back up again at the gas pump. And so inflation is still real and it's still here. One of the things we've been saying at Masters for the last 2 years, since we've seen inflation going up, is a warning that inflation is one of the most persistent economic factors in our economy. That means when inflation goes down, it tends to stay low for some relatively significant period of time. And when inflation goes up, it tends to stay there too for some relatively long period of time. And so the idea that inflation is likely to spike up and spike that back down is just not well supported by the data. And so it's certainly possible that we've seen the worst of it, but the likelihood, historically speaking, of us back to the interest rates and inflation rates we were at 3 years ago is not super high. And so when we're investing and when we're thinking about our cash allocation, we have to think about inflation in that picture. We would have thought of cash as not a good place to have money, let's just say in 2019. I could have had cash sitting in some money market account, and it only might have been paying me somewhere around 0.5%. But if at that time inflation was, let's just say, 0, I'm still winning. I'm getting more on my cash than I'm incurring in inflation. And what we tend to see is inflation and cash interest rates tend to move together for the most part over time. So when inflation is higher, interest rates are higher. When inflation is lower, interest rates are lower, generally speaking. And that certainly plays out in our cash accounts. So right now, it is exciting to think about cash, and hey, I can finally get some money on some interest on safe money, 3-4%, maybe even more than that. But I'm still losing out in real terms because inflation is higher than the yield I'm getting on my cash. So what I can buy with my cash is actually negative. And that's something we have to keep in mind. And is the reason why we would say, let's just make sure you have in cash what you're going to need for the near future. And again, we can help you figure that out. But let's not try to pretend that cash is a long-term investment just because it's paying 3-4% now in these higher inflation environments. What I was speaking to earlier is illustrated in this chart right here. The blue line you see is the average interest rate on a 10-year US Treasury bond going back to the late 1950s. The gray bar is the interest rate minus inflation going back to that same period of time. And what you see is the gap between those bars, with the exception of the 70s, which if you're around the 70s, remember all the crazy things that were happening then, and you remember maybe getting a mortgage or a CD at the bank for 15, 16, 18, 20%. It was a very unique time in the market. But since the early 80s, what you see is a rather linear relationship between interest rates and real rates, so interest minus inflation. But what I want to point out on this chart, if you can see it, is right here at the end of quarter one, we have a nominal interest rate, so a gross rate, if you could think of it. What are you getting paid if you have your money in a 10-year treasury bond? You're getting 3.55%. But inflation is at 5.5% as of March 30th. So that means my real yield is actually negative. I'm losing purchasing power on the money I have in cash because inflation is eating away at that yield that I have. Now you can see that these negative real periods don't typically last too long, but the wild card we have, of course, the Federal Reserve and the moves they make, and that introduces an element that we really haven't seen to this degree before. And so it wouldn't be surprising to see this potentially continue negative real yields going forward, with the Fed, in our opinion, being rather heavy-handed as far as interest rates go and being involved in the economy. But again, it's still fun to be getting paid in cash. It's fun to be making something as long as I have it positioned in the right place. Because if I look back, if I was around with cash back in the 1980s, I was up here getting somewhere around 10% in a 6-month CD. In the 1990s, I was down to about 5.5%, still not bad. In the 2000s, I was at 3.3%. In the 2010s, I was only getting 0.5% on a 6-month CD. So far in the 2020s, we're up to 0.8%. Right now, you could go get a 6-month CD for something in the 4 to 5% range. So we're climbing back up, but again, we have to keep in mind this inflation rate. What you see on this chart is all these gray numbers that I circled are that 6-month CD rate. These other colored bars are various rates of inflation on different parts of the economy. The bright blue is overall inflation. The purple is inflation in housing. The dark green is in medical costs. And the light green is in education. And all we're illustrating here is as the yield on your cash has declined, the inflation rate in most of these other categories has not declined nearly as much. And because of that, your dollars are not going nearly as far as they might have back in the 1990s or the 1980s. Because a lot of these elements, and I would point to housing in particular, housing inflation so far in the 2020s at 5%, when I've only been getting 0.8%, that's not a great equation for all of us who are homeowners or renters or whatever our housing situation is. Those costs have gone up significantly. When the rubber meets the road, the question you have today is, if I've got cash, Gary, Lyle, where should it be? And our recommendation generally is that it should be in a high yield money market account. Money market account is almost exactly like a savings account. In general, the best rates you find are at some of the banks that are online only. Some of the local banks have caught up and they're offering better yields on money market rates. But right now, again, end of quarter one, what this chart's showing us is that just in a short period of time, this is only looking back 2 years, we've gone from almost zero all the way up to about 4.5% is the average money market rate right now. And so our action point for you in this section is go check where your money is, where your excess cash, your emergency reserves, the money you have parked for the next couple of years. Where is that invested and what's your interest rate? And make sure you know that, because we have seen a lot of folks, a lot of clients with their money somewhere where they're still only getting 0.5% or 1%, or maybe there's certain tiers of interest in the account they have and they don't have enough money to get the highest rate. There's a lot of options out there for you to maximize the yield in your cash. And especially with inflation being high, we think that's really important. So that's section one, Lyle. As we went through that, what questions do we have on cash and interest rates and inflation?
Yeah, I have a question here. It's a little bit related. Just a few weeks ago here, we were hearing a lot about the Silicon Valley bank failure. So question here about what are your thoughts about banks going forward? Or should we be concerned about bank failures?
Yeah, great question. If you read our blog, Lyle wrote a blog on this, fantastic blog on this, just about what happened particularly with Signature Bank and Silicon Valley Bank, the two banks that failed. And we also provided a white paper there that provided some more in-depth commentary on that. So if you're interested, I would say go back and read that blog from a few weeks ago. Generally speaking, I would say the week or two after that, that was the headline news in the market was, okay, which bank's next? Is it Credit Suisse, which ended up getting bought? Is it First Republic Bank, which was a large regional bank that a lot of investors thought was the next one to go? Some of the largest banks got together, they funded First Republic and have seemed to stabilize that bank for now. And what we've seen is watching what the market's paying attention to. The headlines about the banks have pretty much subsided at this point. And what can happen with a publicly traded bank is this hysteria around concern with the banks, and investors start to sell their stock in the bank. That reduces the value of the bank, reduces their liquidity, and all of a sudden you have this combination of factors that even a well-capitalized bank could have had problems with liquidity just because of investing activity around its stock. There was some of that in the immediate aftermath of these bank collapses. But I think now what we're seeing is most of the issues in both of those banks were structural issues with those banks. With Silicon Valley Bank, it was the way they invested deposits and when they invested deposits that really created a major problem for them. Essentially, they took too much risk and they did it at the wrong time. And with Signature Bank, which was smaller but still significant, they had significant ties to the crypto industry and companies around cryptocurrencies. And with crypto having a really rough go of it last year, that was one of the main factors that took that bank down. So I can't say for certain, Lyle, if we'll see another bank failure. Certainly at some point we probably will. That's just the nature of it. But I would say at this point, just make sure you're not overextended risk-wise in any one place. If you happen to have more than $500,000 in cash somewhere, just make sure that's in a place that's not exposed to single bank risk. I think that would be our main takeaway at this point.
Yeah, good, Gary. Got a question here related to not needing funds for a while. So let's say we got cash, we don't think we're going to need it for a year, maybe even 2 years. Should I be looking outside of the money market realm? Should I be going to CDs or a couple 1 or 2 year treasuries to maybe lock in this yield that it's up? We got an inverted curve and interest rates might go the other way. Should I lock in rates now if I don't need the money?
Yeah, possibly, but I would say at this point, probably not. The reason being is if you lock up your money, you're making a bet about future interest rates. So you're basically saying, hey, I think locking in my rate today is better than sitting in a money market account and essentially just following whatever the rate of the day is. That certainly could end up being a winning equation for you. It could also be a losing equation for you. None of us know what's going to happen to interest rates over the next year or two, especially because we have this phenomenon where the shortest term bonds have higher yields than longer term bonds. That would actually indicate that at some point shorter term rates should come down, but this wild card of the Fed being so involved with rates is the big unknown out there. The advantage you have of money market is it's always liquid. When you go into a CD type of product, treasury bond, not as much, but you do lose some liquidity. You're also subject, generally speaking, to the value of your money still being tied to interest rates. Treasury bonds are traded on the open market. So if I buy a treasury bond today, it could be worth less tomorrow than it was today. It could be worth less in a month, even if I know I'm getting my money back because of interest rate movement. And so that's generally a risk that at this point, we just don't think it's worth taking or even messing around on the hassle with. An interesting anecdote that we were talking about this morning is I-bonds were paying inflation protected bonds direct with the US government. Last year, we're paying over 9%. Now you're limited in how much money you can put in there. And then there's all these restrictions around if you take your money out too early, you have to give some of the interest back. And so it comes with it a bunch of other risks, primarily liquidity risk. Well, that 9% went to about 6.5% or a little more. And now it's going down to, it looks like under 4%. And so again, you made a bet, maybe it's worked, maybe it hasn't. We just think keeping the money liquid, given that the rate curve is relatively flat, is for most people probably their best move at this point.
Good. One last question here. For those of us who lived through 2008, there was, talking about money markets now, there was some money markets that lost principal value because of defaults in, in companies like Lehman Brothers, companies we didn't think were could or would fail. Is there things that we should be concerned about that in this environment with investing in a money market?
Yeah, it's always possible. It's always possible that you could see that a money market loses a percent of value or 0.5% or 0.1%. But you have to then ask yourself, well, what's my alternative? The alternative would be maybe putting that in a local bank, and there you have your own set of risks. If you have all your money at one bank, you could keep cash under your mattress. That brings its own set of risks. So there's risks with anything we're talking about when it comes to investing. Even when we have cash, there's risks that come along with that. I would say the risks are pretty minor, and I don't think there's great viable alternatives that come with no risk or less risk.
Good. That's all we have right now. Thanks.
Great.
Remember, just throw your questions into the chat feature or the question feature at the bottom of your screen, and we'll get to what we can. Thanks.
Yeah, and I would add one more thing on this. If you do have cash, you're not sure what rate you're getting, or if I'm in the right spot, or do I have too much, do I have too little, just let us know. And we have a pretty good handle on what's out there, and we'll make sure we get you in the right spot. Number two, something we've been talking a lot about after the rough year in bonds of 22 is what's next for the bond market. Now, this is a bit provocative because you know that at Masters, we don't make predictions about what's going to happen in the future. So what we're really doing here is saying what has happened, where do we stand today, and what could that tell us about the current state of the bond market? I've referenced the Federal Reserve a number of times, and that's where I want to start. The Federal Reserve sets the shortest term interest rates, essentially the bank-to-bank lending rate. So when they're talking about rate hikes or rate reductions, that's what we're talking about. And this is the Fed funds rate back to 1999. What you can see is, of course, we know that the 2010s were a period of basically 0% short-term rates. We did experience this rapid increase in rates, which caused a little bit of panic in the markets in 15, 16, and 17. Then, of course, we dropped back down to near zero. And now we've had this really unprecedented hike in rates just over this past year that has sent us all the way up close to 5%. The reason I show you this chart is, one, for historical purposes, just so you see where things are at. You can see that we're pretty close to a high point here over the last 20 plus years, but also to see what is expected going forward. So this blue line, the blue numbers, are what the Federal Reserve expects going forward. The green line is what the market is pricing in based on the prices of securities. And then the purple line is what the Fed would like to get to long term. So if you follow any of this, you've probably heard this. The Fed would like to get back to a 2.5% rate, Fed funds rate, sometime at some point in the future. That's what they're solving for. So what they're doing now is they're trying to get this rate up enough that it increases interest rates, which it has, and that decreases economic activity, They're trying to do that without sending our economy off a cliff or sending us into a recession. And that will slow down the economy enough that spending slows down, which means inflation should slow down, which means then they can go back and get this rate back down to somewhere around 2.5%. What you see is over the next few years, the Fed in blue and the market in green have similar expectations. And they're pretty much expecting that we're at or near a peak Fed funds rate. That's what's being priced in. And so that's why whenever one of these meetings comes up with the Federal Reserve where they're deciding what they're going to do, there's all this talk about, well, depending what they do, the market's going to react one way or another. And this gives you a bit of a roadmap for potentially how investors could handle news if the Fed decides to keep raising versus not raising at all versus reducing rates. Long term, both the market and the Federal Reserve expect that over the next few years, they will be able to get back to lowering this rate, and we'll be back somewhere in the 3 to 4% range in the next couple of years. So that just gives you a set of expectations. To continue on that theme, here's the current U.S. Treasury yield curve. So you own a U.S. government bond at different maturities. What are you getting? Well, things do not look like they're supposed to on this curve. You're getting paid almost 5% in a 3-month T-bill, while if you give the federal government your money for 30 years, you're getting 3.7%. Not a great trade, in my opinion, just looking at this as it stands here. But what this suggests is that short-term rates have to come back down so this curve gets back into a normal shape where shorter rates are lower and longer rates are higher. The challenge that the Fed has to navigate this, which they've already experienced last year with a rough year in the markets, both stock and bond markets, is how do you get rates back down? Because you have to slow the economy, you have to slow spending to get inflation down. How do you do that without sending the economy into a full-blown recession? And that's the challenge that they'll have to face. But historically speaking, this shape of yield curve where short-term rates are higher than long-term rates has not been a good sign for the economy. So we'll see how they navigate this, but just gives you an idea of what you're facing today and really the unique circumstance that we're in with the involvement of the Fed in determining interest rates in our economy. So let's get to bonds. What are we looking at in bonds? This chart's gonna put you back a little bit. I apologize for that. It's really just to illustrate a point. I think you've seen it before. Each box on this chart represents the annual return for a certain part of the bond market, essentially. And I don't know if you can see it, but I'm going to read it to you that in 2022, which is this column right here, the best performing bond sector was asset-backed securities, and it returned negative 3.2%. That was the best one. The worst performer was down almost 18%, and that was emerging market debt. Even an asset allocated portfolio of bonds, so if you held all bonds and you held all different kinds of stuff and you were well diversified, you were down 12% last year. And so this is just to illustrate that 2022 was a very difficult year for bonds, almost no matter where you were. And it might be hard to understand, why am I still in bonds? I just got killed. That's supposed to be my safety net. Do I still need them in my portfolio? But what has happened is when interest rates go up, bond prices go down. But if I hold a bond and I hold it all the way until its maturity date, what do I get back? I get back the par value of that bond. So really the key for bond investors in today's bond market is patience. We need to be patient because the negative return we experienced last year, we should get back over the next few years and then some in the form of getting the par value on our bond, which is right now lower than what we're going to get in the future, and in receiving a higher interest rate than we were before. This chart shows you a number of different types of bonds. The first section is US Treasuries. The second section is various other types of bonds. And it's showing you what is the current yield on those bonds and what have they done so far this year. Well, this year rates have already come down a little bit. And so even if you're just in a 5-year Treasury bond, you're already back up 2% this year, and you're getting about 4% in yield right now. The other reason that we need to think about holding bonds is, even though last year this wasn't as true as it has been in the past, bonds generally go a different way than stocks. So generally when stocks are up, bonds are somewhere around flat, maybe just slightly up or maybe slightly down. And usually when stocks are down, bonds are up. Of course, that didn't happen last year due to the unique environment. But when we look at the correlation to the S&P 500, what we're measuring there is, okay, if I have a correlation of 1, that means that this investment moves exactly the same as the S&P 500, which is the 500 largest stocks in the United States. If I have a correlation of 0, that means I have no idea. The S&P does this and this other investment does this, and there's no correlation. If I have a negative correlation, it means that this investment moves opposite to the S&P 500 to some degree. And so, especially if you're close to retirement, at retirement, in retirement, you're entering a period of time that is going to be really good for you as a bond investor. And this is something that can get lost in the shuffle because last year was so painful. It was a painful year for investors, especially for bond investors. There's no way around that. But what has happened is, with interest rates up, the forward-looking return on bonds is much higher than it has been for really 15 years. And so if I'm getting closer to retirement, we still all age every year, right, Lyle? We all get 1 year older every year. Okay.
Every year.
Me too. I am too.
Yep.
Man. All right. So that's still true. So that means I'm a little closer to retirement, which means every year I need to get just a little bit more conservative with my investments. I need a few more of my investments in bonds than I have in stocks. And so if you're close to retirement, what you're doing is, little by little, you're getting rid of some stocks, you're buying some bonds. This is a fantastic time to buy bonds. You're buying them after they've gotten hit hard last year, and you're going to get 4 or 5% on those bonds going forward, in addition to the price recovery of those bonds. So the bad news was last year's a painful year. The good news is, each year that goes forward, you allocate a little bit more to bonds. This is a great time to be allocating more to bonds, because long term it's likely you're going to get much more out of your bonds than the 1 to 2% you've been getting from your bonds for about the last 10 years. And so that's the positive part of a challenging year. To further drive home this point, this chart shows a number of different types of bonds. Again, you don't need to know the particulars here, but what you're seeing is the gray bar is the 10-year range of interest rates on these particular bonds. The purple is the average. So what has the average been over the last 10 years? And the blue diamond is the current. So gray is range, purple's average, blue diamond is current. And what you're seeing is we have close to 10-year historical high interest rates pretty much across the board. This is all United States, this is Europe, this is emerging markets and international over here, and then this is high yield on this side. And so what you're seeing is we got beat up last year, but for staying committed to our investment philosophy, I waited out getting beat up. It's challenging, it's not fun, but I am likely to get rewarded for that in a pretty significant way going forward, now that I'm sitting towards the top of the averages, just getting paid interest to wait for these bonds to mature. So again, it is a good time to be a bond investor here going forward, believe it or not. And then this is slightly anecdotal, but it's a question that I thought fit in here that we've gotten a little bit, and that's we're worried about the involvement of the government or the Treasury or the Fed in the market? Like, how much of a concern is that? And if you would have quizzed me on this, frankly, I would have gotten this wrong. Lyle definitely would have gotten it right, but I would have gotten it wrong, which is how much of the U.S. Treasury market, so U.S. government bond market, is owned by entities or companies or governments outside of the United States. I would have guessed that's close to an all-time high. And I would have guessed if we look back in history, we would have seen that increase over and over again. In fact, almost the opposite is true. That's what this chart is showing you, foreign-owned U.S. bonds. Look at this. In 2022, we're down to pretty close to a historical low, going all the way back to the mid-70s. When we look at who's holding U.S. Treasuries, that's just this slice. About a third of U.S. government bonds are owned by foreign governments or owned by foreign corporations. About 14% of that's China, about 17% of that's Japan. And then there's some other small countries in here. The rest of it's pretty well diversified. And so I just illustrate this point to say, hey, it's not like one company has the United States over the coals and they can call tomorrow and essentially really put a hurting on us. We've actually reduced that number significantly, especially since the late 2000s. And I thought that was interesting, and I think it's a good thing to remind us of, even though we're seeing, again, more involvement than we typically would in the market. So, Lyle, that's what I had on bonds. What questions do we have there?
Yeah, there's a question. Could you go back 2 slides? And this is kind of in the minutia here, but something interesting. Yeah, right here. Looking at we didn't spend any time on this, but the blue and gray bars represent the risks of rising and falling interest rates.
Mm-hmm.
And it's interesting looking at convertibles, and the high yield market are showing positive, both sides. If interest rates go up, it's positive. If interest rates go down, it's positive, which is somewhat unique. Is
Mm-hmm.
that an indication that this might be a good time to be buying those assets?
Well, of course it depends. That's always the right answer in investing. It depends. But I think one thing that can trick us into thinking is that all bonds are equal. So a convertible bond, oh, that's just like a U.S. Treasury bond. But if you remember, we talked about this correlation piece. Okay, so how similar is a bond to a stock? And when we're putting together a diversified portfolio, one of the benefits of diversification is we have assets that move differently in different types of markets. That's why we hold bonds and stocks, because we want our bonds to do something different, especially when our stocks are down. And so you specifically called out convertibles and high yield. If we look at their correlation, convertibles have a 0.87, so almost 1 correlation to S&P 500. High yield's 0.74. What that tells us is convertibles and high yield bonds are much more like stocks than like bonds. And generally speaking, both of those types of bonds are much more volatile. They move around a lot more than a U.S. Treasury would. So it's a bit tricky because they are classified as bonds, but because of their volatility, because of their high correlation to stocks, we're going to lose the benefit of diversification if we weight more towards those types of securities. We at Masters, our investment review committee, at the beginning of last year, did a significant amount of research on how we could best position our portfolios for a rising interest rate environment. One of the things we looked at were, historically speaking, what asset classes have held up the best in rising interest rate environments. And what we found through all the different ways we can invest and all the unique things out in the market is, over time, historically, the best investment for rising rate environments were dividend paying stocks. Just plain old dividend paying stocks, which we generally have a bias to in our portfolios. And so we looked at convertibles and high yields and all these other, funky types of investments, but there's really no magic in that. And so what we would say at Masters is, we're not going to invest in high yields because they're high volatility, high correlation to stocks, we're just going to put that money in stocks. And then we're going to hold bonds that are bonds and hopefully behave like bonds in the portfolio.
I think that leads right into the next question here, Gary. So how does Masters determine like what mix of, treasuries versus corporates versus municipals? And then how do they figure out where to go on the interest rate curve? Do we stay shorter? Do we go longer? What are some of the dynamics that go into making those decisions?
Sure. So here, all our investment decisions are made by our investment review committee. So if you're imagining Lyle locking me in a closet for 8 hours a day to figure out our investment allocation, that's not how it goes. It's our committee in a room together once a quarter, in most cases, working on how are we allocated and where are we in the pre-established framework we have for how we want to allocate assets. We don't go into those conversations with a blank slate and say, okay, where should we put everything? This here, this here, this here. We have a pre-established framework, and we essentially have a range of allocation for each asset class that's based on academic research, risk level, and what we have out in front of us from a data standpoint. And then we're just debating where in that range we need to be based on the data that's in front of us. And then some of the more granular details, we outsource to some of our investment partners, and they're the ones with the real-time data doing the implementation and the trading within the investments we use, because they're the experts, they're doing it every day, and they're in the trenches, and they're within the box that we have them in, they're making the best decisions based on that. And so we saw a lot of that last year, that with some of our investment partners, there were certain times in the year where they were higher on the maturity scale in bonds, other times where they were lower, but no one's getting outside of the range that we have them in. And so all of that's within a framework, but that's how we make the decisions.
I'll just add one thing here, Gary. In terms of municipals, those are our tax-free bonds. So we do take a pretty significant allocation of municipals on our taxable accounts, people who are going to be paying taxes, just to cut down on the tax bite a little bit.
Yes, exactly. Yep. Good point, Lyle.
I believe that's all we have here, Gary. We can move on. Thanks.
Great. All right. Well, we've talked enough about cash and bonds. Let's talk about some stocks, the exciting stuff. But what about international stocks? They haven't been super exciting for us here the last couple of years. We're now going on a 15-year period where international stocks have, or where the U.S. stocks have outperformed international stocks. The chart you're looking at here goes back to 1971, and what you're seeing are the gray bars are times when the United States has outperformed international. The purple bars are the opposite, when international has outperformed the United States. And what you see is this most recent period has been unique, and it's been the longest by far outperformance period for the United States since the early 70s, but it still hasn't been the highest. It's outperformed by about 225%, versus back here in the late 80s, international had an unbelievable 6-year run where they outperformed the US by 374%. But what we're drawing your attention to here is there's not a reliable, discernible way to say whether US or international will outperform in the future. What history tells us is there are periods where the US does better, there are periods where international stocks do better. And the key is keeping a balanced allocation, but especially international, being very cognizant of where internationally you're investing. And so we're going to get into that just a little bit more. As far as the story goes last year, international stocks and US stocks performed pretty similar in 2022, generally speaking. Not great, double-digit negative returns. But one major element of that for international stocks in particular was the strength of the dollar. So the dollar strengthened significantly back in 2022. You see this on this left-hand chart, where the value of the dollar versus other currencies peaked in September of 2022 and had a pretty significant run up there. at the end of the year. What happens, without getting too much into the detail, a strengthening dollar in most cases hurts international stocks. When we look at performance in 2022, if we don't adjust for the dollar, if we just say, okay, raw return, not adjusted for the dollar, which did better, US or international? International actually outperformed by somewhere between 6 and 7%. So international actually did better last year than the US before accounting for the dollar. But because of the dollar strengthening, it put them in about the same place, slight underperformance by international. And so that's a unique element of investing in international, is the dollar can affect that investment pretty significantly. But for historical purposes, what we see here is the dollar hit a peak, a pretty significant one, even going back to 98, one of the biggest ones except the early 2000s. And if we go back one slide, when was that most recent period of outperformance for international? Oh yeah, it's 2001 to 2008. And how does that coincide with the dollar? That was a period where the dollar really struggled and lost some value. So don't get me wrong, you're not rooting for the dollar to lose value if you have money in international stocks, but it's just another element of diversification that international brings. If the US dollar is weakening, generally that might not be as good for US stocks. But if I know I have international stocks in my portfolio as well, to a lesser degree in the United States, I know that at least somewhere that's helping me. So that was a really important element of what happened last year. To put it in perspective a little more, I want you to direct your attention to this pie chart. That shows you the total investable universe globally. What it shows you is the United States only makes up about 60% of the total investing universe. Emerging markets makes up about 11%. Europe minus the UK is 13%. UK on its own is 4%. Japan 6%. And then you have a few others there. And what I'm drawing your attention to there is if you're not investing internationally or minimally, you're missing out on a big slice of the investing pie. And if we really believe in diversification, which is pretty strongly supported academically, we should be diversified in many, many ways. In stocks, in bonds, within different types of stocks, different types of bonds, and in different types of investments in different parts of the world. Now, here at Masters, we do generally have what they would call a home bias, which means our portfolios, in most cases, are usually more than 60% invested in the United States. And that's pretty common. If you look around the investing universe, most countries, so if you lived in the UK, you probably have more than 4% in UK stocks. And that's really just a way to say, we do believe in our economy. We do want to back the companies that are here in the United States, maybe a little bit more. There's some other elements to that. But we also want to stay diversified. So what do we think of international here? You know, one of the sayings we have in investing is, you know, a bull market or an investing run of some sort, it doesn't end just because of time. So international aren't going to start outperforming just because they haven't. There's got to be a reason behind that. One of the big reasons we would look at for the argument for international stocks is the current price of international stocks is measured by price earnings ratio. You hear us talk about this measurement a lot. It's essentially how many dollars are you paying for $1 of earnings in stocks. This chart here on the left is comparing how expensive are international stocks compared to US stocks. What you're seeing down here is international stocks are cheaper by a measure of price earnings ratio versus their historical average in a pretty historical sense over the last 20 years, as low as it's been relative to the United States. So what that's telling us is, hey, we can buy stocks cheaper internationally than we can in the United States. Now, again, does this mean we don't invest in the United States? We only go international? Of course not. But it could suggest that going forward, because we're simply paying less for a stock, that could be a positive driver for international stocks. And this other chart is a different version of the same idea, and that's the difference between dividend yields in international versus the US. What we're seeing is dividend yields internationally are higher than in the US, again, towards the top of their historical average. So I can get paid a little bit more on dividends as well if I'm invested internationally. And so big picture from a pure valuation standpoint, international stocks do look like they could be prime for a comeback here in the coming years. But of course, those things take time. Again, another chart with a lot of data. This would be good for me to have a little bit of feedback on. Do I just throw too much data out? I try to scale it back, but a lot of time Lyle and I can't help it. We love the numbers, we love the data, and hopefully that's part of what you have us for, is we're out crunching the numbers instead of you trying to do it on your own. But again, what we're seeing in this bar chart are different countries, just a couple of different ones that were chosen. And what are they trading at, that price earnings ratio? How much am I paying for $1 of earnings versus their historical average? The purple is what they're currently trading at, and the gray is what they historically traded at. And you see pretty quickly a pattern here that a lot of these purple dots, almost all of them except for India over here, almost all these countries are trading at historical lows from a price earnings standpoint. What we'd say in investing is that means they're on sale. Again, does that indicate that here in 2023 or here in the second quarter of 2023, all of a sudden international stocks are going to take off? No, this is a longer term metric. But if we look academically speaking, if we pay less for stocks, in most cases, long term, they're going to outperform other stocks that we would pay more for. And so we think this is a pretty good measurement for a long-term investor to use. But again, we have to be careful about where we're at. We can't just blindly invest internationally and just throw money into all these different countries, especially emerging markets, which have less developed economies. We have to rely on being more selective about where we are there. So one of the other things, this is what I'm closing with on the international side, one of the other things we look at a lot at Masters is what have value stocks done versus growth stocks. And usually we talk about this in the context of the United States. A value stock is generally a stock that I don't have to pay as much for its earnings to obtain, and a growth stock is generally more expensive to obtain. And so one of the ways to test an academic theory is if we see something show up in research, we need to apply it to different circumstances and different data sets to see, okay, does this just happen one place or does this happen multiple places? The more places we see something show up, the more confident we can be that it has academic support. And so this value growth idea, where value generally outperforms growth over time because I'm paying less for a value stock than for a growth stock, has pretty good support academically in the United States. And so we said, well, we got to make sure we test it other places. What if we test it internationally? And international, we see the same thing. Again, I think this is one of the investing concepts that makes intuitive sense. If I pay less for something, I should expect that over time, as long as I stick with it, it's going to outperform something that I pay a lot more for. Again, just in general terms. And so when we look at that, that applies internationally as well. In fact, in a lot of cases, it's a stronger indicator internationally if we look at the data, even in the US. And what we see on this chart right here is that internationally, value stocks relative to their historical average are much cheaper than growth stocks internationally. So last year in the United States, we saw value stocks outperform growth stocks by a wide margin, a significant margin. And the chart we looked at in the US beginning of last year looks similar to this. And so this again would indicate that long term, we're paying less for value stock, more for a growth stock. This could be another good indicator for international stocks going forward. So while that wraps up the set on international stocks, we've got a couple more minutes here if we have a few more questions.
Yeah, we have one question uh, about socially investing. So when we're considering international stocks and really domestic stocks, how much credence do you give to social investments? You know, does the fact that we're, we have our faith and that we're followers of Christ, does that make any impact in investment decisions? What are your thoughts about that?
Yeah, well, let's hope that makes an impact in every decision we make, right? It's core to who we are, and it should be reflected in every decision we make. From an investing standpoint, it impacts somewhat, but we don't use that as the lead screen. And the reason for that is if you test that theory down to any granular level that I'm only going to invest in this or that, you run into two major problems. The first problem is cost, and the second problem is unknown information. So I can invest based on what's publicly out there, but I have no idea as to what's going on that I don't know about, those unknown unknowns. And so if we're try to chase a perfect portfolio that has absolutely nothing in it that would be objectionable to us, one, the cost gets so extremely high that it really negates the potential for positive investing. But two, there's still going to be problems there. If we really dig into it, there's still going to be problems. And then how do we apply that to our everyday decisions? I think we all do the best we can. I really think that's the most reasonable position to take is let's make a best efforts approach, but let's not try to pretend that we can be 100% here and 0% there, because we can't do that in our everyday lives. We can't, there's certain things that we can't avoid. And so that would be the general philosophy. Lau, do you have anything to add on that?
Yeah, I just think there's inherent challenges whenever we try to the whole idea of being of the world but not or in the world but not of the world, and it just becomes a very a tricky mix. And obviously there's people out there selling, if you will, these biblical responsible portfolios. We've looked at those. Our opinion at this point is that like Gary's saying, it starts to get very, very messy, and the implications beyond investing also become somewhat impractical. So at this point, we do not use any kind of systematic process to try to screen out certain stocks.
Another thing, it's a bit of an offshoot of that, Lyle, would be when we're looking internationally, there are things we have to pay attention to internationally that we wouldn't pay as much attention to in the United States. One of them would be, say, the stability of government in a certain country, which would go down to the economic level. So there are other social elements that we do have to be more keenly aware of internationally that might not apply as much in the United States.
Good. We have time for one more, Gary?
We got time for one more.
Good. Well, let's end on this. If you go back, I think it's 3 slides, the one with the trends on it. One
Right
more.
here?
Yeah. So looking at this, just as a novice, looking at this chart, and again, we've heard, you and, of course, in Masters, we preach all the time, not to, that we're not trying to predict the future, but these trends seem to be pretty pronounced and pretty substantial. Is there any strategy to lean into this a little bit?
There absolutely is strategy. Absolutely. And the way we apply the strategy goes back to that philosophy we talked about before. We have a pre-established framework, big picture, of how we want to invest and allocate funds. And that's research backed. So again, it's not us just deciding, it's research backed, pre-established framework. But within that framework, there's plenty of flexibility and there's plenty of room to move. So the real world example here with US is we have a range that we want to stay in for how much money is invested in US stocks and a range for international. What happens when the US outperforms, it gets the end of that range. It becomes a bigger portion of the portfolio because those stocks have grown faster than international. And so the inherent mechanism is that when we get to the edge of that range, we can sell off a little bit of our US because we don't want to go outside of that range, meaning we're selling after a good period of returns. And that means we're selling high. And then we're buying international, which is underperformed. We're buying low, but that's being done systematically. I think that's really the key to successful investing. You have to have facts and data to back up your overall philosophy and framework, but then you have to have a proactive, intentional system to apply that framework continuously, and that's how we would do it. So what you would have seen last year in your portfolios, you would have seen a little bit of selling in US, a little bit of buying in international. We also looked at our international allocation in the middle of last year and said, hey, remember we talked about that growth value? We've got a little too much growth in here. We need a little more value and we need a few more smaller stocks. We have too many large stocks because that's what had done well. And we had this automatic mechanism that said, hey, we're a little too heavy on this. Let's, again, take a little cream off the top of the things that have done well, add to the things that are cheaper, and we have that automatic mechanism in place overseen by our team. So that's generally the way we're going to approach those sorts of decisions.
Hey, great, Gary. Hey, thank you, Gary, for all your work. I know you put a lot of effort into preparing these webinars. It's great data. To all of you out there, please give us feedback. If there's topics you'd like to see us talk about, please send us emails. You can even send your ideas through the chat feature here before we close up. And again, thank you so much for joining us here today.
Yeah, thanks everyone for being here. Lyle, I think it's your turn to read the disclosures page. If everyone could stay on for about 20 minutes.
Ready, set, go.
No, thank you, everybody. We appreciate your relationship here with the team at Masters. Anything we can do to help you, please do not hesitate to give us a call, send us an email. Please go enjoy the rest of this beautiful day. We'll see you all soon. Thank you.
Bye.